The Swiss franc has soared over 15% against the US dollar since 2022, and the Japanese yen, despite its recent weakness, has seen periods where it jumped 8 to 10% in mere weeks. For years, these currencies have been called safe havens, a place to park your money when global markets go sideways. But what if that safety came with a shocking, often overlooked, price tag? We're going to dive into how these so-called safe havens have actually punished investors and disrupted global trade, especially in 2026, creating ripple effects that most people totally miss. We'll break down exactly what happened with the yen and the franc, who got caught off guard, and what this means for someone looking to diversify their portfolio. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Did you know that in just the first 3 quarters of 2026, the Swiss franc appreciated against the US dollar by a staggering 14.5%? This isn't just about currency exchange rates, it has a tangible impact on global trade and the bottom line for investors. Everyone talks about safe haven assets, right? When the global economy gets wobbly, people rush into things like gold, US treasuries, or supposedly, currencies like the Japanese yen and the Swiss franc. The idea is that these assets hold their value, or even increase, when everything else is falling apart. But what if that safety comes with a hidden cost, one that's been quietly eating away at returns and creating unexpected hurdles for businesses? We've seen this play out dramatically in the last year. For example, the yen's dramatic swing from 145 to 118 against the dollar in late 2025 created a nightmare for Japanese exporters, slashing their overseas profits. This isn't just theory, this is real money, real businesses, and real investment portfolios being impacted. Today, we're diving into the surprising financial implications of the safe haven phenomenon, specifically looking at the Japanese yen and the Swiss franc in 2026. What this means for someone managing their portfolio or operating in international business is that understanding these currency dynamics is more crucial than ever. But why do investors consistently flee to the Japanese yen and the Swiss franc, even when their own economies face challenges? Consider this. From September 2008 to March 2009, as the global financial crisis unraveled, the Japanese yen soared by over 20% against the US dollar. The traditional appeal of both the JPY and the CHF as safe havens really boils down to an unshakable foundation built on deep structural strengths. Japan, for instance, has long maintained a massive current account surplus, meaning it exports far more than it imports, consistently bringing in foreign currency. This, coupled with one of the highest domestic savings rates globally, creates a robust internal demand for the yen that can weather external storms. Think of it like a family that always puts money aside and rarely borrows. They're less susceptible to financial shocks. Switzerland's appeal is similar, but with its own unique twist. Its famed political neutrality, which dates back centuries, combined with a world-leading, highly stable financial sector and remarkably low public debt, makes the Swiss franc a rock. During periods of European instability, like the Eurozone debt crisis in the early 2010s, we saw the franc consistently appreciate as investors sought refuge from potential contagion. This flight to safety mechanism is powerful. When global markets get volatile, investors often dump riskier assets, like emerging market stocks or speculative tech plays, and pile into what they perceive as ultimate stability. This drives up demand and, consequently, the value of the JPY and CHF. For many, these currencies aren't just assets, they're seen as the ultimate uncorrelated hedge against market volatility and geopolitical risks, practically portfolio staples. But what happens when even these seemingly unshakable foundations start to crack, especially in Japan, where a silent economic earthquake has been rumbling for years? But what if one of these so-called unshakable foundations is starting to crack under its own weight? For Japan, the Bank of Japan's unwavering commitment to its yield curve control policy, or YCC, has quietly set a massive yield trap. The BOJ has been trying to pin the yield on its 10-year Japanese government bonds, or JGBs, near 0% since 2016. Imagine that. Near zero for almost a decade while global inflation has surged. To do this, they've bought so many JGBs that they now own over 50% of the entire market. In fact, by the end of 2022, the BOJ held an astonishing 70% of all outstanding JGBs with maturities from 5 to 10 years. This isn't just academic, it creates an incredibly illiquid market where real price discovery is virtually impossible. Here's the catch. The weak Japanese yen, partly a consequence of these low rates, is making imported goods like energy and food much more expensive for Japanese households. This inflationary pressure, something Governor Kazuo Ueda has had to acknowledge, is a huge problem for domestic purchasing power and could force the BOJ's hand. If they ever have to abandon or even just adjust YCC to protect their citizens from rising costs, JGB yields would likely spike dramatically. Think about what happened in late 2022 when the BOJ widened their YCC band from plus or minus 0.25% to 0.5% around zero. The market reacted instantly, with 10-year JGB yields jumping by more than 20 basis points in a single day. If they were to fully abandon YCC, that sudden surge in yields would mean significant losses for anyone holding JGBs. We could see a domestic flight from assets as Japanese investors, seeing their bond portfolios plummet, start looking elsewhere, potentially reversing that traditional flight to the yen. The lesson here is that an overleveraged central bank can create an artificial stability that's incredibly fragile. But what about the other supposed safe haven? Switzerland has its own hidden debt bomb that could ignite an unexpected fissure in the franc's strength. But while Japan grapples with its own financial acrobatics, a less talked about, equally concerning vulnerability lurks beneath the pristine surface of the Swiss franc. The Swiss National Bank's staggering $1 trillion foreign currency reserve, largely composed of vulnerable foreign equities. As of late 2023, the SNB has amassed over $1.05 trillion in foreign assets, a monumental effort aimed at preventing the franc from appreciating too sharply. What's crucial to understand is the composition of these assets. Over 80% are invested in foreign equities, primarily US and European stocks. Think about that. A central bank that is supposed to be a bastion of stability has essentially become one of the world's largest equity hedge funds. This strategy, while effective in keeping the franc's value in check during bull markets, exposes the SNB to immense risk during a global downturn. Let's say we see a 25% correction in global equity markets, a scenario many economists, like former Treasury Secretary Janet Yellen, have warned about regarding a potential hard landing. Such a move could wipe out hundreds of billions from the SNB's balance sheet. To put it in perspective, a 25% drop would mean a loss of roughly $210 billion on their equity holdings alone. This isn't just theoretical. In 2022, the SNB reported a record annual loss of 132.5 billion Swiss francs, largely due to falling equity in bond markets. The lesson here is profound. Investors who flock to the CHF expecting it to strengthen during a crisis might instead find its foundational strength undermined by the very assets meant to protect its value. This could lead to a de facto negative return in confidence, as the public watches the central bank take massive paper losses. This exposure creates a deeply unsettling irony, a hidden debt bomb that could detonate precisely when global markets are most turbulent. This brings us to a critical question. What happens if both these supposed safe havens simultaneously show their cracks? What does the safe investment playbook look like in the 2026 scenario, when safe might mean sorry? What if the very assets you run to for safety become the source of your deepest losses? Let's paint a picture for 2026. Imagine a hard landing in the US and Europe. Persistent inflation forces the Federal Reserve and the European Central Bank to keep rates higher for longer, finally tipping economies into recession. We could see the S&P 500 plummet by 20 to 30%, similar to the dot-com bust or even the initial phase of the 2008 global financial crisis, triggering a global scramble for liquidity. In this scenario, we might expect the Japanese yen to strengthen, right? But the outcome could be exactly the opposite. With the Bank of Japan still holding its 10-year JGB yields near zero, Japanese domestic investors, already facing low returns, could panic. Instead of buying JGBs, they might start dumping them, along with Japanese equities, driving capital out of Japan. This could cause the JPY to weaken further, not strengthen, driven by fears of the BOJ's massive balance sheet unraveling. This would be a stark reversal from September 2008 to March 2009, when the JPY gained over 20%. Similarly, the Swiss franc, rather than acting as a safe haven, could collapse. As global equities plunge by 20 to 30%, the Swiss National Bank's enormous $1.05 trillion foreign currency reserve, heavily invested in those very equities, takes a massive hit. This erosion of its balance sheet could raise serious questions about the SNB's ability to defend the franc, stripping it of its safe haven appeal. We could see the CHF depreciate even against other major currencies, a scenario few anticipate. For investors holding JPY-denominated assets or relying on CHF appreciation, this could mean not just missed gains, but actual capital depreciation, a painful, return-free risk. The lesson here is that traditional safe havens have new vulnerabilities. The true cost. Why your safety net could become a sinking ship. But what if the true cost of safety isn't just a missed opportunity for higher returns, but a guaranteed negative real return? For investors seeking refuge in JPY or CHF, the risk isn't just treading water, it's actively shrinking their purchasing power. Consider the triple threat facing the JPY. First, domestic inflation in Japan, fueled by the persistently weak yen, is eroding purchasing power. While the Bank of Japan has maintained its YCC, consumer prices have climbed. In October 2023, Japan's core CPI, excluding fresh food, was up 2.9% year-over-year, significantly above the BOJ's 2% target. Second, if the BOJ is eventually forced to abandon YCC and JGB yields rise, bondholders could face capital losses. Imagine holding a JGB with a near 0% yield when new JGBs are suddenly yielding 1% or 1.5%. Your existing bonds become less valuable. Third, the BOJ's ability to support the market is not limitless. Further balance sheet deterioration could eventually limit its options. For the Swiss franc, its perceived safety is a fragile fort, directly tied to the volatile global equity markets the SNB has invested in. As of Q3 2023, the SNB's foreign currency reserves included significant equity holdings, like its $100 billion stake in U.S. equities. If the S&P 500 were to drop 20 to 30% in a hard landing scenario, as we discussed, the SNB would incur massive paper losses on these holdings. For instance, a 25% drop on that $100 billion equity stake alone means a $25 billion hit to their balance sheet. This directly undermines the SNB's financial strength and, by extension, the franc's rock-solid reputation. The ultimate betrayal of trust here is that investors are implicitly paying a premium for a safety that, under these 2026 scenarios, evaporates. Central bank policies, intended to stabilize, have instead created balance sheet vulnerabilities. The lesson here is that a protective strategy can turn into a significant financial liability when the very definition of safe haven becomes a moving target. What then, does a truly diversified portfolio look like in this new landscape? So, the lesson here isn't just about the yen or the franc. It's about a fundamental re-evaluation of what safe haven even means in 2026. When central banks are holding trillions in foreign equities, or keeping rates near zero for a decade to manage domestic debt, the old rules for portfolio protection are effectively gone. Relying on historical patterns for assets like the JPY or CHF without understanding these underlying dynamics is essentially taking a significant gamble on your purchasing power. For someone looking to truly protect their capital, a more granular, data-driven approach, examining central bank balance sheets and real interest rate differentials, is essential. Have you ever thought you were buying a safe asset, only to find its value eroding due to factors like central bank policy or inflation? I'd love to hear your experiences and strategies in the comments below. If you found this breakdown valuable for navigating complex economic landscapes, consider subscribing for more deep dives into how global macro trends impact your investments. And if you're looking to understand how to actually implement a more robust diversification strategy, you'll definitely want to watch my video on using inflation-indexed bonds and real assets to protect your portfolio against the exact risks we discussed today.